Okay, so good morning, good evening, good, I don't know what. This is strange in all parts of the world. But anyway, so I don't want to waste too much of time because I know we've kind of a little short in time. So, I mean, I'm going to talk about this policy framework for financial consumer protection, what we know versus what we don't know from an Indian perspective and how things are looking at out here. So the basic idea in India is that this is a question, and I think this is applied uniformly. Why do we need a consumer protection framework, and why we're talking about this? Because in some sense, the financial services is a very competitive environment, and the whole argument of free market should ensure, if free markets did hold and all of that, that we really don't need any kind of protection or it would be unfair kind of protection for any kind of stakeholder in the process. But the reality is that there are four problems that exist. Information asymmetry, externalities, high search costs and price dispersion, and something which is probably not very well understood as yet, though I know there's a strand of research that's going on out there, which is the behavioral characteristics of the consumers. The primary problem to me still is information asymmetry, because the products are fairly complex, and that has been mentioned by all the previous speakers. The seller, the service provider always has an informational advantage, and therefore this asymmetry kind of incentivizes the seller to mis-sell the product, which can then lead to poor outcome. If we had a perfect market where the buyer is also equally knowledgeable, things would be much better and would not be required. But we are not in that. There could be externalities because the trickle-down effect, decision of action of one entity spilling over to the action of the others, and things like that. Unfortunately, we still don't have a single repository of information. This is extremely true in India, and I think this is also true across the world, where one could go and kind of search and have a knowledgeable outcome about the different players marketing their reasonably near identical products in seemingly packaged differently, and therefore they seem different, which is why they can also get away with a huge price dispersion. Finally, the behavioral characteristics of consumers, which again is not very well understood in my opinion, and I think this is true of behavioral finance as a whole. But at the end of the day, consumer decisions are influenced by a lot of factors which are not always purely rational. It's kind of peer, the peer exposure and stuff like that. Advice from friends and family, as one would call, and that kind of leads to an absence of a rational decision that should be taken. The second thing is, before I specifically go into the Indian context, which is how is this different from some of the other consumer protection in other services? And I've just used retail goods and services as the other alternate, which is kind of a very comparative. But at some level, it's fundamentally different, simply because a couple of things. Most financial decisions are not frequent decisions. This is not a decision of going and buying groceries every week or going out to a restaurant and having dinner, because of two problems. One, these are taken infrequently, and the outcomes are not necessarily immediately clear. The outcomes have a very long-term implication. For example, a pension plan, a retirement plan, or an investment. You do it today, you realize the outcome about 20, 30, 40 years down the line. And at that point, you can't really do any changes on it. So therefore, they are inherently different to the way it works, as opposed to normal other retail products, where outcomes are immediately obvious, and producers can distinguish themselves through various other means. Second, unforeseen or unprecedented market movements can have substantial impact on financial products. And it's impossible to ascertain upfront what would be the reasons behind poor outcomes. Was it because of mis-sell? Would it because of random shocks? So, I'm sure the world will come out of this pandemic. The 6 months, 1 year, 2 years later, if we look at a product which was sold around this time and has not performed, was it because of the pandemic? Was it because of mis-selling? Was it because of something else? It becomes extremely difficult in this confounded environment to identify that. And hence, financial consumers obviously should require a special attention, which addresses the information asymmetry as well as the possibilities of the different outcomes in that process. Okay, this is now just kind of very quickly, and I'm just going to give you some stats because the next couple of slides have an impact of that. So for a country like India, which is one of the largest developing countries in the world, I don't know how one would classify China, but second to China only. At the same time, we have real challenges. If you look at it, only about 34% of the lowest quartile in lowest income quartile have real savings to talk about. 14% of the lowest income quartile actually have life insurance. 1% of the population has medical insurance, and we are facing the problem right now. Other countries like South Korea and all, did get out of the pandemic a little better. We are kind of in the midst of the biggest problem that we have. Approximately 70% of the lowest income quartile do not use formal sources or do not have access to formal sources of finance, and hence they have to borrow from informal sources, and rates could be as high as about 24%, 25%. Demographic wise, the retired population is expected to climb from about 4.6 20 years back to about 9.9% by 2030, which in absolute terms mean that the people above 60 will increase from about 100 million in 2010 to about 200 million by 2030. And by 2050, it's supposed to be close to about 320 odd million. Only about 10 to 15% at the outer limit actually has access to formal programs which is designed for providing income guarantees and income securities post-retirement. Public spending is only about 1 to 1.2. Public spending on health is about only 1.2%, an extremely low amount. And over the next 10 years, it's supposed to go to 3%. In the current, and this was the projections. Now the current thing, they're kind of trying to fast forward it. But again, there is a limitation of how much one can spend. And also, interestingly, about a third of the population, on one hand, while you have a huge demographic benefit, but a third of the population is actually below 50, and there's a huge educational cost that will come up, which in the next few years. So basically, the ability of the system to respond to these challenges will have a significant impact the way, not just the financial market, not just anything, but the overall future of the country kind of what the future holds for the country. So in that sense, and before we go into the financial framework and the protection argument, the future of finance in India is therefore based on, in my opinion, these three pillars of innovation, customization, and competence that I've said. Innovation, because there is a huge demand for financial inclusion, and the standard channels of financial inclusion have not been successful. The rate of growth of the rate at which the financial inclusion should grow is unprecedented, will be unprecedented, and then the attempts and the way to do it would also be at the same time not to compromise on the process of the stability of the system. And I'm the second bullet on some point, and that is this: while innovation is needed, the nature of innovation also has to be socially relevant. And I'll give you a simple example. For a lot of people, in Australia, in the United States, reverse mortgage is a very standard product, and can be used as a means of a retirement planning argument or financial planning argument. Reverse mortgage is a product does not work in a country like India, where there is a cultural ethos of getting associated with a property, and that house or the property is handed down generations as a family legacy. So, the way this innovative products will come in will actually have to be also taking into account the social relevance of that product. And the most important thing, which is where all of this kind of comes in, innovation and all is fine. Consumer needs are extremely complex. We have a country where you have, on one hand, the richest person among the top 5 richest persons in the world, to the poorest people, to among the poorest people in the world. So you actually need to kind of have a product or a set of products which maps for everybody. Different products with a whole portfolio of products. And therefore the complexity is enormous. But at the same time, this product should address all these complexities, yet be comprehensible. And something our previous speakers were saying, be comprehensible to the consumers. Specifically coming to financial consumer protection, unlike the US, unlike UK and Australia and now Korea, we do not have a specific Financial Consumer Protection Act. What we have is a much more general purpose Consumer Protection Act, which is about close to 40 years or 35 years old now, 34 years old now, And consumers have recourse to that law, and then special courts set under that act to kind of go in for that. They have another additional approach, which is to go to the regulator of the financial product. So the central bank, so RBI is the Reserve Bank of India, the central bank. SEBI is the equivalent of the SEC in the US, basically Securities Exchange Board of India. IRDA is the insurance regulator. PFRDA is the pension fund regulator. So these guys, they also have quasi-judicial functions, and consumers have access to these regulators if something is missold or there's an issue, which could then be challenged in a proper court of law. But at least there's an intermediate quasi-judicial function that the regulators perform. But what this basic tenets of this process, the challenge in this process is essentially that there's still enough conflict between regulatory functions, between regulators when they discharge their roles of, on one hand, prudential regulation and on the other hand, consumer protection. And there is still no clear mechanism as to how to deal with this conflict. There is inter-regulatory conflicts because the way the market is developing, and there are a lot of things which seem to be falling through the cracks. And we've had some crash or some crisis falling through the cracks. Only after the crisis happened, people have realized what's going on. And there's kind of a lack, and overall there's been a lack of response to the fact that the world over, there's been a growing body of evidence that consumer behavior and preference does play a part. But in India, we don't seem to have an orchestrated response to that kind of evidence. However, there is some talk that is going on, and I'll highlight that in a second. But in effect, there is this whole thing of they've now come up with something called the FSLRC, Financial Services Legislative Reforms Commission. So there is something which is kind of movement there, and the whole idea has been now based on this philosophy of suitability. And the idea being that the consumer protection will actually have to be disclosure, will move away from basic disclosure-driven arguments to a suitability-based argument. And in short, the onus is being put on the financial services providers and not on the kind of consumers, which is something which the first speaker, Professor Hanna, was kind of mentioning in that Laurent Willis's paper and all of that, and as how just increasing choice or financial education, in a sense, does not really give me a better outcome. So what they're saying is that in effect, that there could be two approaches. One could be information disclosure, which is basically give information and let the people have choice, or suitability requirements where the seller has to kind of identify and deliver the proper product and is held legally viable for it. The information asymmetry and the complexity increasing over time, it seems the most appropriate protection measure would be to put the onus of consumer protection on the financial services provider, which is basically the suitability argument. And this will drive, so what this would mean is a whole shift in the attitude of the financial services provider from this caveat emptor, buyer chooses to provide a liability and align themselves in that model so that their incentives are also in line, because at the end of the day, their businesses, their incentives also align. In some sense, the policy is the talk that's been and should lay down as there should be a suitability policy, and the company must follow in all interactions with the consumers, and it should have the process for consumer data collection. One of the things which is becoming very important is not just collection, but how do I also protect that data from being misused? The analysis, what kind of recommendations do I make? And in the UK, an interesting story that happened was a pension fund problem that they had in the 80s, which they took about 20 years to kind of come out. So we don't get into some kind of a model on that. And how do we continue to kind of do a follow-up on that? It's probably easy once to sell it and then get away with it, but the follow-up is also kind of something which is being talked about and is being held important. The implementation has to be the basis of the financial services providers, evaluation of the financial services provider, and in case of violation, there should be legal penalties so that there is enough incentive for the service provider to act in the best interest of the consumer. There is this whole argument of leak. At some level, I think this is true anywhere in the world, including in India, and I think countries like India, this problem is a little more, that unless there's a legal liability, people will try to businesses have tried to move down the corners and get past the corners without really following it, and therefore there has to be a specific legal liability, and that's what the Regulatory Commission is talking about, that, there has to be a strong ex-ante legal liability and a strong threat of ex-post enforcement to ensure that the financial services providers act in ways which are in the best interest of the consumer, given the fact that most of the consumers are unaware or semi-aware of the products that are being sold, and definitely, fleetingly aware of the other underlying conditions that kind of come in. Okay. Now, at the same time, the Regulatory Commission wants to give, and then the process will also have to kind of look at giving the right, so giving, and under the suitability argument, the right to choose. So what they're saying is, the suitability is to ensure that the financial service provider is incentivized to act in the best interest of the consumer. But it is not mandatory the consumer has to act by the services of the provider. So it does not take away the right to choose, of the right of the consumer to choose. But what it says is that the service provider has to offer a clear set of recommendations, and the final decision, on whether to offer informed consent or rejections is given to the consumer. If the consumer chooses to reject this, the process of suitability stops there, and the consumer is then on his or her own. However, if the consumer does choose the suitability, the service provider's recommendations, then at a later point, if it is found that it was not suitable and it was kind of not in the best interest, there will be legal liabilities. People have, the reason why this is because they had an interim model where people had to sign off on a document, and today also, until the change happens, we have to sign off on a document of any financial investment. And I have been explained, and I have understood whatever the product is. Now, most of the times, most people don't have the ability to ask those questions, and therefore they only get to hear what the service provider or the agent of the service provider tells you. So this is to kind of say that, okay, you might want to take that challenge or take the risk if you know, and if you ask those questions, but if you don't, then kind of go with, then the liability still remains with the service provider. What has been talked about, which is kind of in terms of what my earlier speakers have also mentioned, is that this will become an environment where suitability is the core of the consumer protection, and it needs fundamental changes in the regulatory process. And then the process of belief is that there has to be enabling legal and regulatory framework that the part of the suitability to drive improved customer protection can be realized, because without that, it seems to be that there could be hiccups and challenges along the way, which is avoidable in some sense. Okay. My last couple of slides. So as I said, we are kind of looking at a fundamental review of the process through the creation of what is called as the FSLRC, Financial Services Financial Services Legislative Reforms Commission. Amongst other things, its mandate is to kind of, so one of the problems that we've had in India over the years is we've had new laws come in, and there have been a lot of laws that have come in, not necessarily obliterating the older laws, and therefore, something might be allowed in the new law, but some different kind of protection is granted under the old laws. So one of the primary objectives of this is to simplify and have a more harmonized, a combined financial sector system, so that we do not have multiple laws and multiple jurisdictions and all kinds of things to come in. The effort is also to kind of learn from the US examples or the twin peak models of was evolving in Australia, South Africa, I missed out UK where it started off, and in all of these things. So basically account for all of that, look at the existing system, rewrite that whole thing, and have a simplified but an effective legal regulatory process in that framework. My final comments would essentially be that, obviously, as I said, we'll actually, and I think this is not just going to be applicable in India, this is going to be applicable in again, I think Professor Hanna mentioned that one of the challenges going forward will be with respect to the integration, and he mentioned the story, example of how Europe would have really low population growth or really decline in the population, whereas there'll be booming population sizes and numbers in Africa, which could lead to kind of significant immigration into Europe. And then this would kind of be relevant in that context as well, that the development and the setup should kind of incorporate designs, innovation in design of products, channels of service delivery, technology, so that this actually matches and is relevant for the people that are kind of need it and work around that with appropriate information disclosure. The equilibrium of consumer protection should shift from the buyer beware to a regime where the service provider has to ensure provision of suitable financial services to the consumers and not just random kind of ideas and things like that. Because all said and done, the markets will not move towards, will become better but not become perfect, and therefore the information asymmetry will remain. Suitability should be one of the most important legal conditions and legal rights for all financial consumers. In general, for all consumers and financial consumers, all the more. And that will kind of make sure, the stronger that we make this, that will make sure that the service providers, the financial service providers, will act in the best interest of the consumers, at the same time align their businesses so that they will kind of also be profitable and also survive in the whole thing. But at the same time, they will not impinge on the fundamental rights of the consumers to choose what they want, but their consumers' best interests will also be kept in mind. And that is what should be, therefore, the mechanism to take into account the sustained improvement in financial outcomes for consumers over a much longer period of time. Thank you. I hope I kind of